Hey, this is Chris from Stockspot, and it's that time of the year again, end of financial year, and a time where a lot of people who own shares or ETFs are thinking about tax and how you can be smart about lodging your tax and making the most of your investments without paying too much of it. So in this video, I wanted to answer 3 of the common questions we get from Stockspot clients about tax, and specifically tax on their ETF investments. And the first one is, should I sell my loss-making investments before June 30? This is a common question, and it's really referring to something known as tax loss selling. This is the idea that if you've made some profits in some investments during the financial year and realized gains, you can offset those realized gains by realizing some losses in other investments, so you're only paying tax essentially on the difference between the two. It's a common strategy that people use, and one that can help you reduce your tax, but one that you need to be very careful of. And that's because while you are allowed to sell loss-making investments for a genuine reason, like you're changing your strategy or you no longer think it's the right investment for you, the ATO looks very carefully at sales of investments for what's known as wash sales, or where someone sells an investment only to buy it back very soon after. And this isn't legal in Australia because this is seen as selling the investment simply for the purpose of realizing tax. So it's something to consider if you're looking at a different strategy or looking at switching into different investments, but be very careful because it's not something you're allowed to do if you're just selling to buy back again. And it doesn't have to be a day or two later, it could be a few days or a few weeks later. It's still potentially considered a wash sale and something you need to be careful of. So selling to crystallize a loss is all right, but just be very careful of that particular issue. The next question we get a lot is, can I claim my Stockspot management fee as a tax deduction? And the general answer to that is yes. If you have paid a management fee to manage an investment portfolio, the cost of managing that portfolio is tax deductible. That could be the fee that we charge, or if you see a financial advisor, any outside advice you're getting around structuring or how to set up your affairs may also be tax deductible. In the Stockspot annual investor statement, we actually show you where on your tax you can actually claim your Stockspot management fees as a tax deduction. And if you do see a financial advisor, you should ask them or ask your accountant or tax advisor which parts of their advice fees are potentially tax deductible as well. The last question we get a lot from Stockspot clients is, how do I work out the capital gains and income from the ETFs I own? And this is an area where I think a lot of people get stuck in Australia because they assume that it's quite easy to calculate tax on ETFs, where in fact it's quite complex. ETFs are structured as basically managed funds, and managed funds distribute all sorts of different types of capital gain and income, and you actually need to account for all of these separately in order to correctly do your tax each year. And so if you do own ETFs on an online brokerage platform or another sort of investing platform, what you'll typically need to do is go to the actual registry that they're listed at. Often that's Computershare or Link Market Services, and then go and download each of the annual tax statements from each of the ETFs you own. And then they will basically split out the different types of income and capital gains that you've earned within those funds. That could be foreign sourced income, local income. You could be getting some franking credit benefits. And because of the buying and selling that happens within the ETF, there may also be a level of capital gains. And there's also a different type of capital gains that can get passed on through a tax cost-based adjustment or an AMIT cost-based adjustment. So there's a bit of complexity there, but the annual tax statements should really capture it all. If you own multiple ETFs, you'll need to aggregate these all together and put them in your tax statement. Although some of these are passed on directly by the registries to your accountant, so you should ask your accountant whether they've already been passed through. If you do use a service like Stockspots, what we do is aggregate all of these for you into a single statement, and so you can log on to the Stockspot dashboard, and rather than getting all of the individual ETF statements, we just give you a single one-page statement that would show you the total tax in each of those areas to put on your tax statement. So you can simply give that one-pager to your accountant or use it yourself on MyTax to do all of your tax. So to summarize, those 3, tax loss selling is something that a lot of people do, but make sure you're doing it for a legitimate purpose that isn't considered a wash sale, but it is a way of reducing your tax. Yes, your Stockspot management fees are generally tax deductible, but of course, ask your accountant if you're concerned or have questions. And then finally, The ETFs themselves are paying lots of different types of income and capital gains, so it's important to get them right so you don't stuff it up. It is an area that the ATO is looking at carefully, so make sure you declare all the types of income and capital gains you're earning. ETFs are wonderfully tax efficient instruments over the long run compared to other types of investments like managed funds, because they have lower portfolio turnover typically, but it doesn't mean they're not a little bit tricky to manage, and so do make sure you get your tax right and so you don't get on the wrong side of the ATO.